School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 4 Financial Statement Analysis, Unit 14 Ratio Analysis.
The unit aims to acquaint you with the ways to analyze changes in financial performance, helping you to prepare analysis statements and reports from financial statements, acquaint you with the technique of inter-firm analysis, and explain the DuPont analysis technique. Introduction. In the previous chapter, we learned about the various financial ratios: profitability, leverage, activity, efficiency, and investment ratios, how to calculate them, and the interpretation of these ratios was also something that we learned. Estimating these ratios for 1 year provides some insight into the functioning of a firm. We are in a slightly better position in understanding the complexities of a business enterprise. Calculating these ratios is the first step in this exercise. Such financial ratios have limited usage as conclusive comments cannot be made. Further analysis is therefore required to be made in order to reach to some definitive conclusions. In order to understand the financial statements of a firm and hence comment on the financial performance, we need to compare the ratios over time and compare them with other similar companies. There are various tools and techniques to achieve this, which we will discuss in this chapter. Comparative statement analysis. A common approach to study the changes in the financial performance of a firm is to simply compare the financial statements for at least 2 years and calculate the changes between the 2 years. Such an analysis is called comparative statement analysis. In this analysis, financial statements of at least 2 years need to be considered. For example, consider the balance sheet for a hypothetical company ABCA Limited for 2 years, year ending 31st March 2020 and 31st March 2021. Next, we calculate the change for each line item of the balance sheet 2021 over 2020. We also express this change as a percentage over the base year, that is 2020. For example, the long-term borrowings in 2021 was rupees 1,466.11 crores, while in 2020 they were rupees 1,562 crores, a decrease of rupees 95.89 crores. In percentage terms, this is a fall of 6.14% over 2020. That is 1,466 minus 1,562 divided by 1,562 into 100, which is equals to minus 6.14%. Similarly, we calculate the change and the percentage change for each line item of the balance sheet and income statement. Such an exercise helps gain insights into the financial statements, that is, which items of balance sheet and income statement have increased or decreased significantly over the 2 years. Such an analysis may be extended to include more number of years. Similarly, a comparative statement may be prepared for the income statement as well. Common size analysis. Another way to analyze the financial statements is by preparing a common size statement. In this, each item of the balance sheet is expressed as a percentage of total assets or total liabilities. For example, equity capital in the year 2020 is rupees 356 crores, which is 7.15% of the total liabilities of rupees 4,979.95 crores. Similarly, all other items of the balance sheet are expressed as a percentage of the total assets or total liabilities. In this analysis, the financial statements are redrafted to be expressed in terms of common base, that is, total assets or liabilities in case of balance sheet and net sales in case of income statement. Therefore, such statements are called common size statement analysis. Trend analysis. Another important technique of analyzing the financial statements is to examine them over a period of time, say over 5 years, and study the trend over the years, especially in items of income statement like sales, profits, or items of balance sheet like net worth, debt, etc. Inter-firm analysis. Besides investigating the financial statements of the company in question, analysts also compare the financial performance of the firm with its close competitors or the industry averages. Such an analysis is referred to as inter-firm analysis or cross-sectional analysis, which enables the analyst to compare the firm's performance with its competitors or industry average. The financial ratios are compared with firms that are similar in terms of sales, asset size, market share, etc. in order to examine the financial performance. DuPont analysis. The most important aspect of a firm's operation is the rate of return the firm is able to generate on the equity investment made by the shareholders. Equity shareholders are the real owners of the firm and take all the risk. Hence, the return on equity or ROE needs to be analyzed in greater depth. This is achieved by the DuPont analysis, which breaks down the ROE ratio into its three important components. These three components of performance measurement are profit margin, asset turnover, and equity multiplier. Hence, the equation becomes return on equity or ROE equals to profit after taxes, that is PAT, divided by equity. This equation can also be written as a product of the mentioned three components. So the equation becomes ROE equals to profit after taxes divided by net sales into net sales divided by total assets into total assets divided by equity. Net profit margin indicates profitability. Asset turnover ratio evaluates the efficiency in the usage of the assets of the firms, while equity multiplier is a proxy for financial leverage. Thus, the DuPont analysis highlights that a firm may increase its ROE by maintaining a high net profit margin, efficient use of total assets, and optimum leverage. If the ROE falls, the firm must investigate these three financial performance measures to identify the reasons for such fall and take corrective steps. Using financial ratios to predict bankruptcy. Edward Altman investigated cases of business failures in the US. In his study, he included a sample of 66 industrial companies, of which 33 were bankrupt firms and 33 non-bankrupt firms for 20 years, that is, from 1946 to 1965. Based on the data provided by the annual reports of the companies, Altman examined a total of 22 potential financial ratios, out of which he retained 5 ratios that had the highest significance based on statistical techniques that were most important ratios in predicting business failures. Altman used the multiple discriminant analysis, that is MDA technique. This technique categorized firms into those that are likely to fail and those that are not likely to fail. Based on his study, Altman developed a formula which combines these 5 ratios and assigning weights to each of these ratios to arrive at one composite score, which is called the Z-score. So the formula is Z-score equals to 1.2x1 plus 1.4x2 plus 3.3x3 plus 0.6x4 plus 1.0x5, where x1 is equal to net working capital to total assets, x2 equals to retained earnings to total assets, x3 equals to earnings before interest and taxes to total assets, x4 equals to market value of equity to total liabilities, and x5 equals to sales to total assets. x1 equals to net working capital to total assets. It is a measure of the net liquid assets of the firms relative to the total capitalization. As discussed earlier, net working capital is the difference between the current assets and current liabilities. This ratio explicitly considers the liquidity and size of the firm. Generally speaking, a company that is experiencing consistent operating losses will have shrinking current assets in relation to its total assets. X2 equals to retained earnings to total assets. Retained earnings are the accumulated earnings or profits of the firm. In this ratio, the age of a firm is implicitly considered for a relatively old, well-established company that will most likely have a higher ratio than a relatively young firm, which is more susceptible to fail in its initial years of existence. X3 equals to earnings before interest and taxes to total assets. This ratio measures the productivity of the firm's assets independent of the effects of leverage or tax. As the existence of a firm is based on the earning power of its assets, this ratio is appropriate to study business failures. X4 equals to market value of equity to total liabilities. This ratio indicates how much the firm's assets can decline in value relative to the market value of its equity and become bankrupt. X5 equals to sales to total assets. This ratio, also called the capital turnover ratio, indicates the sales generating ability of the firm's assets. According to the study by Altman, if the Z-score of a firm was greater than 2.99, then the firm is financially sound, while if the score is less than 1.81, then the firm is financially not healthy and is most likely to go bankrupt. Firms with Z-score between 1.81 and 2.99 fall in the gray zone, wherein the model could not predict business failure or otherwise. The Altman's model that we discussed so far was for manufacturing and listed firms. Subsequently, he revised the model for unlisted firms and non-manufacturing firms. In the revised model, the equation becomes revised Z-score equals to 6.56x1 plus 3.25x2 plus 1.05x3 plus 6.72x4. where x1 and x2 and x3 have the same meaning that we discussed earlier, while x4 equals to book value of equity to total liabilities. If the revised Z score is greater than 2.9, then the firm is considered financially healthy and not likely to go bankrupt. If the revised Z score is less than 1.23, the firm is considered financially weak and likely to go bankrupt. Firms with revised Z score of greater than 1.23 and less than 2.9 fall in the gray zone. Currently, several advanced tools are used for predicting bankruptcy, including use of artificial intelligence. Applications of financial ratios. Ratio analysis is an important technique of analyzing the financial performance of firms. Different stakeholders use financial ratios to evaluate the firm's performance from their own perspective. Hence, there are different applications of financial ratios. They are: number 1, assessing the performance of the firms. As mentioned earlier, different stakeholders want to evaluate the financial performance of firms from their perspective. Shareholders want to evaluate if the business enterprise is profitable and financially strong or not. Short-term creditors and suppliers of raw materials want to know if the company would be able to repay the short-term credit which they have provided. Lenders of long-term finance are interested in the long-term solvency and profitability of the firm. Management is interested in the overall performance of the firm. Thus, each stakeholder wants to examine and evaluate the financial statements from their own perspective. Ratios are also used to rank companies. For example, financial newspapers like Economic Times, Financial Express, and Business Standard, and websites like Money Control and Yahoo rank companies on an annual, or quarterly performance. Number 2, credit analysis. Ratios are used to judge the creditworthiness of potential customers. Ratios like current ratio, asset test ratio, debt equity ratio, interest coverage ratio are evaluated to decide whether credit should be extended or not, or further loans should be sanctioned or not. Number 3, forecasting bankruptcy. As discussed earlier, Altman's Z score is an important technique to predict the chances of business failure. Number 4, valuing firms. Valuation of firms is an important aspect of the usage of financial ratios. As the valuation of firms is dependent on the profitability and efficiency of a firm, the valuation ratios such as EV to EBITDA ratio, MV to BV ratio are used extensively by analysts. Issues in using financial ratios. Although ratio analysis is an important tool in the analysis and evaluation of the performance of a firm, there are certain issues while using them. Some of the issues in using the financial ratios are: number 1, the financial ratios are calculated based on the financial statements, the balance sheet, income statement, and cash flow statement. These statements, as we know, are historical in nature. They summarize the financial transactions of the firm as they occurred in the past. Hence, the financial ratios based on these historical statements are backward-looking and are at best post-mortem of past events. An independent or outside analyst who does not have access to the future plans of the firm, relying on the past data, may not predict the future performance and financial position of the firm. Number 2. No two companies are exactly similar in their asset profile, capital structure, technology being used, markets, products, etc. Further, companies also change over a period of time. Hence, as the profile of companies changes, it becomes difficult to compare the ratios the comparison of ratios with other firms or over time periods might become problematic. Number 3. Although the financial ratios have been defined as discussed in the previous chapter, there exists a wide variation in the definition of certain terms which makes the comparison of ratios difficult. For example, though the debt-equity ratio is well defined, what constitutes equity is subjected to variation, as some may include preference capital in equity while others may not include it. Similarly, the term profits are also subjected to different interpretations. Number 4. Besides comparing the ratio over time, they are sometimes compared with industry averages also. Such a database is maintained by the Reserve Bank of India. Prowess database maintained by the Center for Monitoring Indian Economy, that is CMIE, is another such database of Indian firms. Such industry average ratio is based on all the firms that constitute that industry, which may vary in size. Some firms may be very large in terms of sales and profits, while some firms may be very small. The industry average would give equal attention to both these types of firms. Comparing a firm's ratios with such an average ratio might be misleading. Now let's summarize the unit. In order to understand the financial statements of a firm and make conclusive comments on the financial performance, we need to compare the ratios over time and compare them with other similar companies. Techniques such as comparative statement analysis, common size analysis, trend analysis, and inter-firm analysis are popularly used. DuPont analysis decomposes the performance measure of return on equity into its 3 important components that need to be investigated in depth for reasons for poor performance. Altman's Z-score is used to predict the possibility of a firm going bankrupt in the near future. Properly combined financial ratios are used to assess corporate excellence, judge creditworthiness, predict bankruptcy, and value shares. Although financial ratios are a useful tool, there are certain issues encountered. Hence, ratios should not be used blindly but with due caution.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ruchi Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.